Welcome to the Planet MicroCap Showcase Virtual 2022. I'm your host, Robert Kraft, and I'm really excited to introduce Team Canada for the Stock Pitch World Cup. Moderating this panel is I go to him for everything, all things Canadian microcap, not resource mostly, but anything Canadian microcap. This is my guy. So Paul Andreola from Small Cap Discoveries. Paul, thank you so much for doing this.
Hey, Bobby, always fun to catch up, always fun to be involved, and love the approach we're taking this time around.
Yeah, it's a cool format. It's really fun.
It's the way it's the theme that we're seeing in full speed in the World Cup right now. So yeah,
listen, we're just hoping that Team Canada, the Stock Pitch World Cup, does a little bit better than Team Canada, the actual World Cup. But
they set the bar pretty low, so we should be able to do okay. Yeah, mind you, you know what? I'm proud of the team. They did score their first goal in World Cup history, so it's a baby steps.
Davies is good. Davies is good.
The guys are good. Are good. Yeah.
But anyways, before we get into the actual pitches themselves, I've been asking this to all the moderators, is to just kind of give their 2 cents on the region itself and why folks who are listening in or watching this right now should be paying attention. So I'm going to ask that same question to you. Why Canada and why now?
Well, you know what, Bobby? I mean, I think about 15 years ago, I remember I pitched a Canadian story, the MicroCap Club down in the U.S., and I almost could hear the boos and hisses and people, because I think a lot of investors still look at Canada as a market of mining stocks and junior oils and things like that, and it's just not the case. There are a lot of those here for sure, but there's a lot of great businesses that I think are obscured by both sort of the larger stocks that are in Canada and the sort of the mineral exploration and extraction businesses that are out here. And these tend to go sort of undiscovered and less known, and of course more mispriced because of that. Now, I've noticed some really smart investors and a few guys that you've had from competing teams here. They're always up here in Canada looking in my backyard looking for deals. So they know that there's some great stuff up here. And it's just that, the microcaps are sort of more left alone up here, and there's no real strong analyst coverage in the small space. So we have great deals that if you're willing to look hard enough, you can find them.
Absolutely. All right. Well, so without any further ado, let's get cracking on these stock pitches. So Paul, let's rock.
Let's rock. All right. First up for Team Canada, we have Sharon Wang, Senior Analyst, PenderFund Capital Management. She'll be talking about Copperleaf Technologies. Sharon, take it away.
Hi, Paul. How are you? Hi, everyone. Today I'm going to talk about Copperleaf Technologies. It's a Vancouver-based enterprise software company. PenderFund is currently a shareholder of the company. So the company, what they do is they provide decision analytics software. Decision analytics software for infrastructure companies to optimize asset planning. For example, utilities companies would use them to decide when and where to invest in capital assets to minimize risks, meet regulatory approvals, or maximize capital efficiency. So the company started back in 2000 as a consulting company, and after the current management team come in, they around 2010, they started to pivot to a pure software company. And in the last couple of years, they have been transitioning to SaaS, software as a service. If you look at their revenue streams, they actually have 3 streams of revenue: subscription revenue, which includes the SaaS revenue, and maintenance and support. That's over half of their total revenue. And then the other 2 parts is the perpetual license revenue and professional services. Right now, almost all the major sales are SaaS subscription deals. However, because their customer base are utilities companies, and some actually of their customers would prefer to capitalize expenses. So that's why they still have part of the revenue as perpetual license revenue. They have customers all over the world, and they went IPO at the TSX exchange last year around October. As of Q3 this year, if you look at their company, they generated about 76 million of total revenue in the last 12 months. And the revenue growth is at a healthy clip of 19%. But if you look at the chart at the left, the annual recurring revenue, which is the subscription and maintenance and support revenue, they have been growing very fast from 2018. As of Q3 2022, it was a 27%. And the other important metrics for SaaS companies are the net revenue retention, which means, at the beginning, how much revenue is still captured at the end of the period for the same customer group. So they have a healthy 109% net revenue retention, which means, at the very beginning of the period, they got $100 from the customers, but at the end of the period, they got 109, which means a healthy expansion. And they also have a pretty healthy revenue backlog, which is 93 million, and that would give us a pretty visibility for the next year revenue. So if you look at the company's snapshot, you would think this is a very good company, growing and have a healthy backlog, visible revenue streams, and very sticky customer base. However, if you look at the stock chart, it was pretty ugly. They peaked at over $25 about a year ago and came down, right now trading around sub $5 level. And the market cap is only a little bit over 300 million, but they have 150 million cash on the balance sheet. And from a revenue multiple perspective, they're trading around 2 times. So I believe there is a big mislocation between the value and the price for this company. The reasons are here because they are, if we evaluate this company from a quality perspective, they're a very high quality company from the TAM, team, and unit economics perspective. The 3 legs of stew for a quality company. They operate in a very big market, billions of dollars, a lot of utilities companies, not just utility companies, but other sectors like water utilities, railways, and transportations. They're expanding to new sectors as well. And most of the time, they're competing not really with the real competitors. They're competing with, spreadsheets and some homegrown software solutions made by those companies. They have examples where at first, those companies think, we could make the software. We don't really need you in our decision-making process. However, after a couple of years, they actually came back to Copperleaf and asked for their solution because they realized they can't really do the same thing as what Copperleaf does. And most of Copperleaf's competitors are focused on, how to make the workflow more efficient or focused on financial decisions, while Copperleaf took a very different approach, which is a value-based approach, basically transforming the way companies making decisions and benefits all the stakeholders, not just the shareholders. So it's the sector actually right now has many tailwinds. For example, ESG considerations, energy transitions, carbon emission, and all that would be very good tailwinds for this platform because all their conversations right now with their potential customers all start with ESG. They do help the companies to bring value from that perspective as well. They have a very, very sticky customer base. They never lost a customer. For a SaaS company, it's very important if you have a sticky customer base. You don't really need to be on the treadmill, constantly chasing your customer. So in their case, it's almost the dream scenario. They never lost a customer. They have a very healthy land and expand strategy because they're generating really high ROI for the customer. They're driving exceptional retention rate. If you look at their history, the retention rate would be a little bit lumpy because they still have the perpetual license revenue in there. However, it's in that 105 to even 120% range. Very impressive. And they have multiple growth drivers ahead. They typically start with one line of business in that customer. For example, if it's utility companies, they probably start with their electricity department, and then they'll expand to their nuclear department, and they probably start with one module of this platform, and they have 3 modules for Copperleaf. They start with one, and then the customer realize they probably need to apply this to many other new scenarios as well, so they got another module from them. And then, like I said, they're expanding to other verticals, and they have made a really great success in that they expanding from the utilities to electricity utilities to water utilities in UK, and they recently won quite a few big contracts from the UK water utilities company. And in this whole challenging macro environment, their customer base is ideal because they are utilities companies. We are always going to use electricity, using water, so it's very resilient in this environment. And the final leg of the stool is the management team, and the management team has been with the company over 10 years, and they are a very qualified and experienced management team. They were originally for Creo, another Canadian technology firm, which was bought like over 10 years ago, and the whole team basically were here right now with Copperleaf. They were very disciplined. Basically, they grew the company to this scale almost without any outside capital. Most of the part is bootstrapped, so they're very disciplined. And I think part of the, if you look at the stock price chart, part of the market perception is this company has been growing really fast, and they probably they're burning money, and probably they're going to be profitable. However, that's not true, because before they went IPO, for 6 of the 8 years, they are actually profitable. They are self-sustained. So if they want to become profitable again, they could, and they do have a visible path to it. It's just because right now the market opportunities are so big, and they are at a really very early stage, and they really want to capture the market. So they invested pretty much a lot of money in the market sales and marketing and R&D to capture this opportunity. But the management team is very disciplined, and is ingrained with a disciplined cost structure. So we really think this company could grow 20 to 30% in the foreseeable future. And given the mislocated valuation gap, we think this is a great investment opportunity. That's my pitch.
Fantastic. Sharon, I'm supposed to ask you questions, but I think you covered everything I wanted to know. The only thing I can ask, and maybe is the insiders. What kind of position do they have? What's the percentage ownership of I guess the board and any insiders?
They actually own quite a significant part. Judy has the CEO and the president, but actually she's transitioning to a more. They actually hired another president for the role, and she owns and the board owns about 20%, including like PenderFund. We own over 10%. So the insiders. We have a representative on the board as well, so the insiders own quite a bit. It's quite aligned.
Fantastic. And then, you mentioned all sorts of different customers, but is there any notable customers that we know if you mention the names?
Yes, one of them is Duke Energy.
Mm-hmm.
It's quite a big customer for them, and they have been staying with them for over 10 years already.
Fantastic.
Yeah.
Fantastic.
That's one of their like most renowned customers.
Mm-hmm, mm-hmm. And so $147 million in cash. Do we know what they're burning on a sort of monthly basis or quarterly basis?
Yes, right now they're burning about $20 million per year. However, they have, because in the past 12 months they have been heavily invested in the sales, marketing, and R&D. They're not really going to increase that spending. So from now on, we should be able to see a flat expense structure with with those efforts, like with those investments actually generating profits, right? Generating more incremental ARR. So fantastic.
That's all the questions I have, Sharon. I think you did a great job. Like I said, you answered most of my questions before I could even ask them. So thank you for that.
Okay, thank you. Thank you for being easy on me.
You betcha. We've been speaking with Sharon Wang, a senior analyst, PenderFund Capital Management. Thank you again, Sharon. We're not shareholders of Copperleaf Technologies. All right. Next up from the French-Canadian side of the country, we've got Mathieu Martin, a portfolio manager, Rivemont MicroCap Fund. Mathieu, take it away.
Thanks, Paul. So before we start, just a quick disclaimer to say that this presentation is for informational purposes only. These are not recommendations or investment advice, and the Rivemont MicroCap Fund owns a position in the stock that I will talk about. So my current topic is a company called MediaValet. It's a MVP on the TSX. So the stock is trading at $1.16 with about 41 million shares outstanding, and the market cap is about 47 million. So what the company does, it's a digital asset management platform, and I'll refer to it as DAM, D-A-M. So think of digital asset management platform as kind of a Dropbox on steroids. Okay, so let's say Paul, you and I have some files to store online. We might use a Dropbox, and it's fairly straightforward to find where our digital assets are and use them properly. But if you're a big company and you have maybe tens of thousands of different digital assets, or maybe millions of them, you need a more robust platform to store those files. So to store, pictures, videos, other types of files, and to search for them, to tag them appropriately. Also for multiple users to find those files and use them. So the company has developed an enterprise class platform for that use case, and they also developed a lot of features like some AI and machine learning tools as well. The platform is based on the cloud on Microsoft Azure, and so it's very easy to scale globally. And the company has over 450 customers that are paying on average about $22,000 US. So a quick overview of the market opportunity. The DAM market is fast growing, as you can see on the chart. It's expected to grow at 19% CAGR for the next several years. This market has been around for about 30 years, and initially the players in the market 30 years ago were commercializing on-premise software platforms. So essentially, the customers bought a perpetual license to the software, and they would host it on-premise. So it was very costly, and only the very large companies would adopt a solution like that. But in the last 10 years or so, many new players came onto the market with cloud-based platforms sold on a subscription basis, and so this decreased the price of the software and allowed many more smaller companies to adopt a DAM as well. So today, about 80% of sales opportunities are still greenfield, meaning the customer is adopting a DAM for the first time. So lots of opportunities to grow for MediaValet and also many other players as well in the market. And finally, MediaValet is growing faster than the market. So my thinking is that they are probably doing something well and something valuable to be able to go faster than a fast-growing market. So in terms of financials, the company has an annual recurring revenue CAGR of 40% in the last 5 years. Their ARR is now up to over $13 million. Their retention rate is 100% this year, and even if we look at COVID in 2020, their retention rate only dropped to 97%. So you can see it's a very sticky solution. And since it's a fast-growing market and they have a sticky solution that the customers will keep paying for several years into the future, it just makes sense for MediaValet to invest heavily in sales and marketing and research and development to develop a great platform and grab as much market share as possible in the early stages of this growth market. Now, this is probably the most important slide or thing that people should understand about MediaValet. is that when you look at the financials, you need to focus on billings and not reported revenue or reported net income. And I'll explain why. So MediaValet sells a subscription. It's typically 1 year, some go up to 3 years with an annual renewal. And what's important to understand is that the customers are billed upfront. When they subscribe, they pay for a full year in advance, or if they renew for a full year in advance. And so the cash flows coming in, they come in when it's billed on day one, and then the revenue gets deferred. So it's on the balance sheet, it's deferred revenue, and it gets recognized in the income statement over time, over the length of the subscription. So if you look at reported revenue, it's a lagging indicator because the cash flow has already come into the company. So you need to look at billings to see what are the real cash inflows coming in every quarter. And the company discloses that every quarter, the billings number. So on a billings basis, the company is on track to reach cash flow break-even within 18 months without any dilution. And that's according to me, according to my model, but also according to management. Management has stated that publicly several times, that they don't expect to need any additional capital beyond what they already have available. So 2.9 million of working capital and also a 7 million unused line of credit. So in essence, the company will be cash flow positive way before they get to net income profitability. So if you understand that dynamic and you look at it on a cash flow basis, I think you will be ahead of the curve and be able to make better decisions than other market participants. Now, in terms of valuation, I looked at the SaaS Capital Index, which is an index of publicly traded B2B SaaS companies, so very similar to MediaValet. And that's at the end of October 2022. So the median valuation was 6.8 times EV on ARR, and the median peer growth rate is 22%. On the other hand, if you look at MediaValet, it's currently trading at about 3.5 times EV on ARR, and with a better historical growth rate of 40%. So just on a multiple re-rating alone, I think MVP should be worth to $2.25 per share, or almost a double from current price. And then you still have a nice business that's growing 40% for the foreseeable future. So just a summary why I like it. It's a compounder. I think they have a solid track record of revenue growth, and I think they can continue to grow at that rate going forward. They have a great management team and board, and they are aligned with shareholders with an insider ownership of 39%. It's a very predictable business. I think it's fairly easy to make forecasts because they have recurring revenues, they have high margins, and they have a high customer retention rate. It's fairly undiscovered given its small size, and I know it's not as undiscovered as some of the names you find, Paul, but still, given the market cap that is under 100 million and also only 2 analysts covering the stock, I think it has room to become more discovered over time by larger institutions. And as it gets discovered, I think there's a good likelihood that we'll see a multiple expansion over time. And at current valuation with the comparables that I see, I think it's unlikely that the multiple would contract from here. So that's it, Paul. That's my pitch.
Thank you, Martin. Thank you. Again, you guys do a great job. You're making my job hard and easy at the same time. Very few questions. Like I asked Sharon, perhaps maybe identify some of the clients they have. What kind of customers do they actually have, if you can name a few?
Yeah, well, their biggest is Universal, so the big like movie company. So you can imagine that they have several thousands or probably millions of different digital assets. So they have a few large customers like that. Most of their customers, actually, they don't disclose publicly in press releases. But if you look at the investor deck, I believe they have a slide where you can see all the logos, and there are some fairly well-known in there.
Mm-hmm. Yeah, now I actually know the company quite well. I'm not a shareholder, but management team and certainly the chairman is sort of well known in Western Canada in the tech space. Maybe talk a little bit more about the management team or any of the other key people.
Yeah, for sure. So the chairman, Rob Chase, that's actually the person who introduced me to who pitched me the company the first time. So he was at Absolute Software for I believe about 15 years, and I'm going off memory here, but he was a part of the senior management team, and they grew the company from something like 4 million in revenue to 100 million over the course of 15 years. And so he has a very solid track record of growing a SaaS company in Canada. And he's been a big supporter of the company for several years. He's invested a lot of his own capital as well in the company. And then you have some very good people on the board too, most notably the Francis Shen from Shen Capital, who's also a well-known investor in Canada and well-known entrepreneur, a very accomplished entrepreneur. And so I think Shen Capital owns close to 20% of the shares outstanding.
Mm-hmm. Fantastic. Yeah, like I said, Martin or Mathieu, you did a fantastic job. So I'm out of questions here.
Paul, I know your criteria, so I made sure everything was in there.
You know me well. That's fantastic. So we've been speaking with Mathieu Martin, portfolio manager, Rivemont MicroCap Fund, speaking about MediaValet. Thank you so much, Mathieu.
Thanks, Paul.
All right. Next up for Team Canada, we have another ringer, Ryan Irvine, President and CEO of Keystone Financial. Ryan, take it away.
Thank you, Paul. I'm going to disclose first that Bobby will be moving my slides today. I'm going to thank him so much for that because I'm apparently technically illiterate on the system right now, and he's going to help me with that. So if it's a little misaligned, we'll see. The other disclosure we'll make is we are shareholders in Dynacor, and our clients are shareholders in Dynacor. It is funny that I am talking about a mining related company because generally we rip apart the junior mining sector in Canada on a daily basis. But this company is a little different. We'll get into why. It's Dynacor Group. The company purchases its ore from government registered producers in various regions of Peru and then essentially processes it at its wholly owned mill, not a mine, but a mill facility to produce gold and silver, primarily gold, which is then sold internationally at market prices. Dynacor has a very simple business model. Their profitability depends on two factors: a margin between the price of ore purchased and the market price of gold when it's sold. The higher the margin, the better. The second element would be throughput, the amount of ore processed. The higher throughput, the better. Generally during a quarter, generally during a period of time, a higher gold pricing environment encourages more small scale miners to mine, which grows Dynacor's ore supply, creates profitable growth. Fluctuations within a quarter in terms of margins in the quarter can occur if the price of gold is trending up, which would be positive for margins, or the trend of gold is going down, which would be negative for margins. But this tends to average out with the fluctuations of gold prices within a given year. The company's based in Montreal, has been operating in Peru for 15 years, and has been profitable for 11 consecutive years. Here's a little summary on the screen here of our coverage. We consider this company a spec buy or speculative buy because of the geopolitical risk operating in Peru. Fair value $425. It's in the gold milling industry. We recommended $1.30 to $2. I've owned it since then and bought at even higher prices. Again, high risk geopolitically, currently trading around 260. Market cap around 100 million, so considered a small cap for sure in the Canadian market. Pays a good dividend of 3.8%, and it's in our small cap area of research. So let's move on to why we like it. That would be the next slide. So why do we like it? There's 11 consecutive profitable years with this business. Like I mentioned, that is something that's really unheard of in the gold-related sector. Very strong balance sheet. Net cash here is 42% of the market cap. It'll self-fund growth plans with no dilution, not issuing shares. And we can look to see how the cash price or the cash per share has grown over the past 4 years here. This is all from internally generated cash flow, not from going to the market, issuing shares, and raising capital that way. In 2019, we can see here 20 cents per share. Today, $1.10 per share. That's significant growth in the balance sheet, all while paying and increasing a dividend. And we'll talk about that in a sec. You can move to the next slide. Dividend growth is what we like here. It is a dividend growth stock. You can see in the next slide that there is awesome. From 2018, you can see here, since the dividend was introduced, the company has aggressively grown that dividend every year, more than doubling it since 2019. The payout ratio remains a conservative 25%, and we expect another dividend increase to start 2023. So we'll move to the next slide. It has reasonable valuations, which is something we look for in our GARP, or growth at a reasonable price, our model, and we'll talk about those valuations in a second. And it has growth and diversification place in plan going forward. So let's look at the 3-year financial summary of this business. We can see here sales in 2018, US dollars 104 million, up to 95.9 million. That's 88% growth. EBITDA up 124%. Earnings per share, which is key here, up 150%. Dividends up. It's 100% there. It's annualized at 10% now. Again, we expect an increase in the dividend in 2023. So let's look at some more granular financial information year to date on the company. So this would be the 9 months. We see revenues rose 3%. They've basically at capacity that they just increased. So there is around 3% growth over the 9 months. Earnings per share was up to 22 cents US from 20, or 30 cents Canadian from 27. Cash position here, we talked about this, 31 million in the bank, $1.09 per share, and no debt. The outlook for guidance there, you can see, 4 to 14%, and they're hitting that range by the end of the year. Or net income should hit that guidance range as well. There's some near-term headwinds here. This is an opportunity. Share prices pulled back, still done well on the year, but pulled back. Q3 2021 was essentially an all-time high. They included a one-time sale of gold that was held by the Peruvian government. There's lower average grades over this quarter compared to last year, and gold trended lower during that quarter, which shrinks margins in quarter. So that's why you saw lower revenues in that quarter and profitability. We expect that to correct into next year. So here's the 3 to 5 year growth strategy. The plan is to use the cash generated from the existing successful mill in Peru to expand, replicate this proven model in other geographies. And that's where the real upside here would be. It has an existing plant, the Veta Dorada, Peru South plant. It expanded this again in 2022. This is something we continue to see. Its nameplate capacity there is around, right now, is up to 600,000 tons per day. They just went up to 500,000 tons per day. So there's still some expansion there allowable over the next year. But with the real growth that we expect to see is in Peru North, where we see higher grades available. It's an underserved market. Received little ore right now from this region. We believe the operation is already underway in terms of constructing that. And we should hear news on this in the first 3 months of 2023. The initial plant would be about 150 tons per day and range in terms of CapEx between 10 and 15 million. And that would be funded from cash on hand. Then following that, 9 to 12 months to construct and permit operations. You could see operations there optimistically in 2024. They have a joint venture in West Africa as well, in Senegal. We should hear news on that in 2023. They're also looking at other areas in West Africa where small-scale mining operations are prevalent. Number 4 there on that list in terms of expansion would be South America. Currently, management has one plant in due diligence phase. Whether they purchase it or construct it They have the cash on hand, 31 million in cash on hand to build it themselves or acquire. So let's look at our investment thesis here. Strong dividend grower. We saw that yielding right now 3.6%. That balance sheet is in place for expansion. Geographically, the plan is to have 4 mills operating in the next 3 to 5 years. Whether it be in Peru, we think the next operating mill comes out, but Latin American countries and West Africa is what they're targeting as well. The existing Veta Dorada plant was just upgraded last week. I just mentioned this. Capacity went from 430 tons per day to 500. So that's 16% growth built in. That'll build into the numbers next year. So we'll have growth while we wait for new plants to come online. Fair value. Well, the company trades at 5.9 times earnings per share, actual earnings per share, and at about 3.5 times if you remove the cash per share. Those are low multiples. So if we apply a 7 times multiple, our expected 2022 earnings, we get a fair value in the range of 425. As far as insider ownership, there's 39 million shares out. CEO owns 1 million. Insiders own roughly between 15 and 20%, and they've been net buyers of the stock this year. So overall, shareholder friendly, share buybacks, dividend growth. We expect another dividend increase next year. Now, if Dynacor is the only stock you own in your portfolio, you're crazy. There's high geopolitical risk. If it's one of 15 to 20 high quality growth and dividend growth stocks in a well-built portfolio, it makes sense. And that's all I've got for you today. Paul, if you got some questions, I am here.
Thanks, Ryan. Another great job. Again, you answered most of my questions as you went along there. So just let's reiterate a couple of highlights. I think you said so. The company's obviously got plenty of cash. They've got growth plans. Now they do have that cash, like you said, that is sufficient enough for their current growth plans. Correct?
Yes, I mean it should take them through 2 mills, and the thing is they're generating cash flow, 10.5 million US for the 9 months this year. So they're just building up cash on the balance sheet. Even with the dividend, I mean, they have room to continue to increase 25% payout ratio right now. You know, everything looks great fundamentally. The risks here is, you know, Peru is geopolitically risky, right? There's a left-leaning new party in power in Peru, and that's your risk, right? Like, you can't really allay that country-specific risk until they move into other jurisdictions. That's what we'd like to see. They were successful in Peru. Running this model, going from a net debt position to a huge net cash position. If they can replicate that model in other markets, you know, it has growth upside from where it is right now.
And just gold. They don't look at any other metals.
They would, but gold is their sweet spot, right? They know the business. It's great to, you know, just stick to what you know. I mean, there is small amounts of silver that's been processed, but you're really, it's a gold milling company. And we would love them to stick within their knitting and do what they do best. They know that market. They know the international market, which they sell onto. They could do silver for sure. But, you know, right now we'd expect gold.
And do you ever see a company like this getting acquired? Is that a possibility for something like this?
You know, it would be someone who just wanted to milk the cash flow, like a private equity firm. I think they're really very much underfollowed, unknown. You know, there could be a time. I mean, there's one other, I think Inca One is a company in the market now. They're not profitable, but you know, they're in Peru as well, and they mill. Like, I'm not predicting anything, but there would be more of a chance of Dynacor swallowing up a company like that. Although, you know, Dynacor's facilities are, we would say, more cutting edge. So we would, you know, I'm not sure if they would be looking to acquire a company like that.
Fantastic. No, I think it's a great story. I love that it's obscure and sort of
very obscure. Well, we thought we'd bring a little unique obscureness to the presentation, because as if we didn't bring enough with our technical difficulties, right? We'll have a company that's unique, cash rich, and you know, as one of 15 to 25 companies in a portfolio, I think it makes sense, and it's going to pay you that dividend. It's increased that dividend a number of times already, so we expect it to continue to do that. Exactly.
And for disclosure purposes, I'm not a shareholder, but I'm always intrigued by these type of businesses, because everybody looks at mining as a long shot, right? And there's always these these companies within the sector that are real businesses generating cash. And
they actually do have a property too. If you really want to, it's we assign zero value to it basically,
Sure.
right? But I mean, they have an exploration property within Peru. There is many companies out there that have a property like this and have a market cap of 50 to 100 million. Well, you get this massive cash producing mill along with that property. So if you want to play your junior mining company, here's a junior miner, but they also make
they also make money,
thousands in cash flow, which is great, and they'll pay you to own the stock. So it's
fantastic. No, fantastic story. Thank you so much, Ryan. We've been speaking to Ryan Irvine, President CEO, Keystone Financial, Dynacor. Thank you so much.
Thank you, Paul. Have a good day.
You bet. All right. One more for Team Canada. We've got Harold Leishman, Senior Investment Advisor, Canaccord Genuity. Harold, take it away.
Thanks, Paul. Bobby, thanks for having me. So I'm as Paul said, advisor with CG Wealth Management. Today we're going to talk about Boardwalk Technology. I am a shareholder and we do own the stock for clients. Briefly, who we are. So I'm part of a 9-person team. I run the venture capital portion of the team, the high risk situations. My partner Mike does the more conservative stuff. It's all driven on quant-based screening processes. Our disclaimer: these are the opinions of me and my team, and not CG Wealth Management. And we'll get on to Boardwalk Technology. So one of the reasons we picked this name is it's actually a little bit difficult to understand the story. So we think it's generally misunderstood in the market. As I said, we're primarily quant-based. This is sort of a summary of their financials. The quarterly revenue, you can see, is growing at a rapid rate. It sort of picked up after being flat for a very long time, and trailing 12-month revenue is now also growing greater than 25%. One of the main risks in the deal, I think we should always talk about risk, is the company is currently EBITDA negative, losing about $1 million a quarter. These numbers are all in USD, as is the valuation. Stock chart. This company's sort of been in transition for a while. They were heavily encumbered with debt, about $5 million US. Back here in 2021, they were able to get rid of that debt. Part of it was a conversion to equity, and part of it was via an equity placement. They've used those funds to pursue growth. And then it's been a difficult market, so it's obviously had some volatility. There is a lack of liquidity in the shares, so that's an additional risk for sure, is understanding share price volatility. Now, what does the company do? They take highly complex sets of data. So this is a customer example. They have Heineken, and this is on Boardwalk's website. Heineken USA manages 9 brands. There's a variety of different sizing in their product. They sell through distributors, and those distributors sell through retailers. And Heineken has to figure out where to spend their marketing dollars based on price point. So they end up having about 40,000 different data pieces, and a certain percentage of those are moving at different points in time. And how do you know sort of where you are in time? So they're able to consolidate that data and keep track of who's made what change when, so they can go and audit in history. Oops, sorry, too far. What changes have been made and how that affected the outcome. So in terms of auditing for something like tax across all of the different states and so on, they can figure out if the data's the tax has been paid and the data is accurate. Also, was their promotion successful? They spent money based on price point for marketing, and it's a big part of their budget. So it's a little complex, but that's what they do. They do have a blue chip list of clients, which is what we like, or one of the things we like. You can see some of the clients here: Heineken, Estee Lauder, Ernst & Young, these are the different verticals that they're working on. Most recently, they did add another vertical they landed a large banking client. They announced it as sort of a top, I think it was a top 10 financial institution based in New York City. And that's had some significant impact on their revenue growth, and we think could be a significant driver of future revenue growth. It is a SaaS business. They converted their business to a SaaS business in 2018. This is a summary of their revenue broken down. The blue line represents their annual recurring revenue on a quarterly basis. So you can see it's growing at about 100%. And like many SaaS businesses, it is a land and expand situation. So here's an example of one consumer care product company they had. They started with $85,000 of annual recurring revenue in 2021. It's gone up, whatever that is, 3 or 4 times by this year, and they expect that to continue to grow. So with these large blue chip customers, there is a lot of room for expansion. One of the reasons we picked this for this particular competition is we think it's one of the torquier names out there. We think the revenue growth is very sticky. Client retention is north of 90%, and client revenue expansion is also north of 90%. And another potential driver of growth, this is in a sort of a snapshot of their financials. You can see the marketing expense has gone from $27,000 a quarter to $250,000 in the quarter. This most recent customer win with the financial institution actually came from one of their customers called HCL. HCL is an $11 billion information technology business, and they brought in the financial institution. They are sharing in the revenue, and we think going forward, that could have a significant impact. Currently, Boardwalk has only 5 salespeople. If you add on HCL and potentially others as sales conduits for your product, we think that the revenue growth could be significant. Quick look at the customer list. The financial institution is not in there, it's unnamed. And very simply, right now, enterprise value to annual recurring revenue is just under 4 times, based on management's guidance, which is upwards of $7 million US. Their fiscal year end is March. We think it'll be 3 times, and going forward, we think it dramatically contracts. The valuation dramatically contracts going forward. So it is a rapidly growing SaaS model. We've tried to find competing products. We haven't been able to find anybody that does something similar. I said the big risk is they're not profitable. We think that profitability could be on the horizon with management's stated growth rates. And in terms of proof of concept, we think that's established with the blue chip names that they have. So that's my 3-minute pitch.
Awesome. Sorry about that, the little delay there. Thanks, Harold. So this is another business that we know fairly well. I'm not a shareholder of it, but happy to see the consistent growth that we've seen here. Back to some of the questions that I sort of been asking everybody is just give us a sense of the sort of the makeup of the shareholder base. If you know what's the insider ownership, and are you aware of any sort of significant institutional type of investors?
Insiders have north of 20%. I forget the exact number. It might be 23 or 25. There is the fund that had the debt originally did convert into equity, or a big chunk into equity. So they would be a block out there, and the rest of it I think is just somewhat scattered around. So the shares are quite illiquid. So that is that adds an additional challenge for investors.
I'm going to throw you a bit of a curveball question, but I mean, this is a Canadian tech, Paul. Sort of I love to do it. A microcap Canadian tech name. I would argue that in Canada, these always get sort of misunderstood or mispriced or sort of left alone. What do you think it takes for a company like this to get recognized properly and get the sort of the comparable value you see typically in the U.S.?
Yeah, I think that is a challenging question. I don't think the company's done a great job necessarily of telling their story. I think they are looking to upgrade their listing in the U.S. And I guess would be spending some time and effort trying to get their story promoted down there. But I don't know the answer to that. Sorry.
Gotcha. I was hoping your wisdom of the general markets would help us out there. Okay, perfect. Well, no, listen, thank you. Thank you. I think you did a great job as well. Boardwalk Technologies. We've been speaking with Harold Leishman, Senior Investment Advisor, Canaccord Genuity, or what do you guys call yourselves now? It's not Canaccord Genuity.
CG Wealth Management.
CG Wealth Management. Always changing the name.
A nice rebrand.
Nice rebrand. Exactly. Thanks so much, Harold. We'll catch up soon.
Thanks, Paul.
All right, Paul, that does it for Team Canada at the Stock Pitch World Cup. Thank you so much again for moderating this. Where can our audience go and find more information to follow you as well as Small Cap Discoveries?
So Small Cap Discoveries, you can find me and our team and more information on Small Cap Discoveries at smallcapdiscoveries.com. You can follow me on Twitter at Paul Andreola. And you can follow Small Cap Discoveries on Twitter at smallcapdisc, DISC. Bobby, this has been a lot of fun, and I look forward to hoisting the cup this year.
Love it. Thank you, Paul.
You bet.